Okay, good afternoon, everybody. We're coming to the last session, but by no means the least. I think this morning we've already, or not this morning and earlier this afternoon with Francis's contribution, we've had a hugely rich set of contributions unpacking, if you like, the complexity of the concept of economic inequality. What we're going to do this afternoon, or at least this last session, is to switch focus to one of the most important of the drivers of inequality, and that is the issue of jobs, and even within that, one dimension of jobs, and that is wages. We also heard many people say, and it's one I would endorse this morning, about the importance of research and rigorous research and empirical research to provide the counter discourse, to provide the base for a counter discourse. And so we're really pleased that in this the centerpiece of this afternoon's presentation or contributions will be an empirically based analysis of income distribution over the last 30 or 40 years. This piece of research has been sponsored, I'm pleased to say, by both TASC and FEPS, along with support from the Irish Congress of Trade Unions and others. And it's been conducted by Professor Özlem Onaran and her colleague Thomas Obst from the University of Greenwich. And so they're going to make the empirically based case, if you like, for a wage-led recovery. Their focus is going to be an analysis of economic inequality in the EU15 countries in the period 1960 to 2013. And so therefore, because they have detailed information on each of those 15, they are going to have interesting things to say about the Irish case. And of course, we're always most interested in ourselves. But they're also then going to talk about the case for the policy outcomes of their research, and that's the case for a Europe-wide wage coordination. Now, and I think it's Özlem who's going to make this presentation, when she's finished, just to say what the rest of the session will be about, we have two people to respond and to amplify the arguments and the analysis that we'll have heard based on the research. The first of these will be from Ronald Janssen, here beside me, who's a researcher with the ETUC. He's going to present further data to back up, if you like, or support the findings that Özlem will be presenting. And then I think he is going to give us a very interesting critique about the European Commission's response to the idea of, or how they're going about the idea of wage coordination. And then we'll have a second, if you like, amplification of the developing argument, and that'll come from Dr. Tom Healy from the Nevin Economic Institute. He's the director of the Nevin Economic Institute. And he will be talking, among other things, about the implications of the proposal for wage-led growth on the Irish case, and in particular. In particular, he'll be talking about the relationship between wage levels and Irish competitiveness, and I think drilling down into the distinction that needs to be made between the traded and the non-traded sector. So that's the setup. And then once we've had those contributions, we will then have, I hope, about 30 minutes or even longer for interaction with the floor. So we'll start with Özlem, please.
Thank you very much. Thank you for inviting us, and in particular, thank you for giving us the space to do this research as well as the motivation. I would in particular like to thank Nat O'Connor, who was here, part of TASC last year when we were developing the idea for the proposal first, and we had very productive discussions with the colleagues from ICTU as well. So that gives us really the motivation to go further, and thanks to David Back, the current director of TASC, for taking it forward, and to FEPS for forming this brilliant network of really progressive think tanks and relationships with the unions. So this builds on some of the former research that we have been doing for a while, looking at the negative impact of rising inequality, in particular declining share of labor in national income on growth. The predecessor of this research was a project we had carried out for the International Labour Office that formed the background of their global wage report in 2013. And this particular research we are going to discuss today with you, that's the first launch of the report, is particularly focusing on Europe. The previous version was putting Europe in the context of the global economy. We had looked at G20 economies, and in this case we are looking at the European Union as an integrated economic region. So the question is the economic impact of rising inequality on growth, and as I said, we are focusing on one particular dimension, that is the class dimension, the functional income distribution between wages and profits in national income. We will look at each individual 15 Western European Union member states, including Ireland. We don't analyze the effects on the new member states of the European Union because we need longer time series data to do the sort of econometric statistical analysis we are doing here. So I will be talking about Europe, but to be precise, I will mostly talking about the EU15. And hopefully I will walk you through the tedious work we have done in terms of modeling and estimating the model for each of these countries. And I'm hoping this will give the social movements, trade unions, the confidence to push forward the sort of demands that they have been standing for the decades that brought us to here. So the idea is to share with you some of the technicalities and the tedious details, but hopefully I will have some time to discuss what do we mean with these findings, what do we learn from it, and then how do we move forward if inequality has been detrimental to growth, how to reverse that. So this is the picture of the inequality that I will be talking about. In the morning, we have seen inequality mostly from a personal income distribution point of view, mostly from the top income share point of view, or for that matter, the bottom 90% point of view, or the vast majority's income share point of view. This is the distribution of income between labor and capital, between wages and profits. So we have selected here some of the EU15 member states, the larger countries, and we have put Ireland in context such that you can get a feel. Ireland is the orange line there. Now that I think about it, Thomas, maybe we should have put green there. It would have probably it would have been easier to identify, but we didn't think about the colors and nationalities that way. We should learn to maybe put flags next time too. So this is data going from 1960 to the recent data we have available, 2013. It is adjusted for the labor income share of the self-employed. There is, in terms of the big picture, if you concentrate for a moment, we had relatively high and stable labor shares in the 60s, 70s. Of course, these are for countries where we have data even going back to the 40s, 50s. This is an outcome of the equalizing trends of the post-World War era. So we are talking about labor shares of about 70-75%, including the labor income of the self-employed. And then what you see is a very clear reversal of these equalizing trends of the 70s. Sometime in the late 70s, early 80s, a reversal is starting, a redistribution from labor income towards profit income, towards capital is starting. And this continues, that's a secular trend. Most of us elsewhere have also made the point that this fall in the labor share has been one of the most destabilizing macroeconomic features that have led to twin follies, if you like, of debt-led consumption-driven growth coupled with export-led growth models. Debt-led consumption in Ireland, in the UK, coupled with export mastership in Germany, in an effort to fill in the gap in aggregate demand, in growth motor that is left in the void through this falling labor share. So what we see, if you focus for a moment in the orange line, that is Ireland, from the peaks of about 75% labor share in national income, mid-70s, late 70s onwards, we are seeing a decline, and this decline is becoming particularly remarkable in the 80s, going all the way to about until 2001. Then we see a little bit of a recovery, but nowhere close to covering the loss of ground of the labor share. So from the peak to the early 2000s, we are talking about a redistribution from labor income towards profits, towards capital of more than 25 percentage points. That's a massive redistribution of income. And whatever was recovered in the early 2000s was lost again, particularly after the Great Recession. Sometimes when I hear people speaking, but on the run up to the Great Recession, wages in Ireland were increasing, I want to say, well, compared to what? Compared to the bottom, maybe wages were improving, the share of wages in national income were improving, but compared to where labor was in Ireland in the late 1970s, certainly that can't be recognized as a recovery. So overall, from mid-70s to where we are now, in Ireland, labor has lost more than 20 percentage point of its share in national income. This is actually one of the highest losses of labor share in income in Europe, to put it into context. Elsewhere in Germany, we are again talking about orders of magnitudes of about 10 percentage point of redistribution from labor to capital. So sometimes the German model is praised in Britain and Ireland, but the same German model has also seen quite deterioration through the neoliberal restructuring in Germany itself, along with other European Union member states. In Britain, the orders of magnitudes are again close to almost 10 percentage point redistribution of income. So why are we worried about that? We are intrinsically worried about inequality. This was our discussion in the morning. But also from a sheer macroeconomic efficiency perspective. If you want to talk to a conservative, and this is what some of the unions in Britain at the moment are trying to do. We are doing a project for Union 21 in Britain, and we have aspirations to present our findings not only at the Labour Party and TUC fringe events, but also at the conservative fringe events in their conferences. So they should worry too. Why? This is now a summary of what has been happening to growth in the EU15. The blue line is just the EU15 aggregate, the aggregate of the selected countries I have shown you, along with the other member states of the EU15. The fall is remarkable, again, from early 80s onwards. We are talking about more than 11 percentage point of redistribution. The red line is added on top of that. That's GDP growth. We know that development is broader than GDP growth, but a lot of the mainstream audience that will challenge you on efficiency versus equality grounds will say, well, inequality is what we need for growth. It's the driver of growth. Have a look at the data there, the red line. If you take the average of the growth in national income in Europe in the 60s to 70s, compare it with the average of the post-1980s, it's very clear that the redistribution from labor to capital in the last 3 decades have gone along with lower growth on average, as well as more volatile growth. And the Great Recession is just the last proof and the incarnation of this. So inequality has not achieved what the conservatives told us that it would achieve. And I couldn't summarize the story better than this headline of the Financial Times, which had referred to our previous research for the International Labour Office. Down there you see the reference to me and my colleague Yorgos Galanis who had done the previous research for the ILO. Capital gobbles labor's share. It's true, it has really gobbled labor's share of the orders of magnitudes of 20 percentage point in Ireland, more than 10 percentage point elsewhere in Europe, but victory is empty. Why is victory empty? Because it hasn't led to a stable growth path for capitalism itself. It has destabilized capitalism, both economically, but also socially and politically, of course. So why is this victory empty? This is all what this project is about. What happens when the share of labor, the share of wages in national income decrease? In this project, we have estimated the effect of this fall in labor share on components of aggregate demand. The components of aggregate demand being consumption, private investment, and exports and imports, net exports, that is, exports minus imports. Of course, there is also the government spending. We are concentrating on private demand only, because that's the rumor that higher profitability would trigger private investment, would trigger international competitiveness, and that will generate more growth. Government spending is better minimized and left on its own and outside this picture, according to the mainstream idea. So let's concentrate on private demand, we said. The model is slightly more complicated than that. For each country, we are estimating the effect of wages versus profits on consumption, profitability on private investments. Then we are also looking at the impact of labor costs on domestic prices, inflation that is, as well as export prices. Then we are looking at the effect of relative price competitiveness on exports versus imports of each country. Having estimated this aggregate model for each country individually, then we are also looking at what Keynesian economists call the national multiplier effects. Any change in demand would trigger further changes, obviously in investment, because investment isn't just about profitability, but it's also about demand. It will trigger further effects on household consumption, and it will have further repercussions for imports, because imports is a function of the country's income. Now, mind you, if I go back for a moment and ask you the question, what happens when labor share falls to consumption, to private investment and net exports? Now, the mainstream story would only tell you what happens to private investment and net exports. They would say, profitability rises when wage share goes down. Surely that will be good for boosting private investment. It will be good for international competitiveness, because this means lower labor costs, so it will boost your net exports, and this is what you should be doing. If you go back and read European Commission recommendations, they explicitly say that Europe needs wage moderation. Wage moderation is the polite word for a policy that will lead to a fall in labor share. Wage moderation means, and they explicitly write that, real wages have to grow at a slower pace than the productivity of labor. That means your share in the pie has to fall. This is what will make Europe the most competitive region in the world. This is what will create more growth and then more jobs for you. The reason why we have a crisis of productivity today, according to the European Commission, even after the massive Great Recession, and their policy recommendations for recovery in Ireland, in Greece, in Spain, is still the same. We need wage moderation, meaning a fall in labor share. A further fall in labor share after 3 decades of secular decline. What they don't talk about, and their models don't have any space for that, is what will happen to the first item there. That's household consumption. Now, there's very robust evidence that if you redistribute from workers' incomes towards profits, domestic consumption falls. It's very simple why that happens, because workers consume more out of their income, out of wage income, compared to the profit income of the rich households, of the capitalist households. In technical terms, there is a word for that. Marginal propensity to consume out of wage income is higher than marginal propensity to consume out of profit income. That doesn't mean that the people who earn a high income or profit income consume less than us. That means while they make 100,000 euros a year, 200,000 euros a year, they would consume maybe half of it. It's a lot of consumption. But compare it to a wage-earning household who would be making 20,000, 25,000 euros a month, a year, they would be probably consuming all of it, isn't it? Their consumption as a ratio to their income will be very high. So if you redistribute then from this group of wage earners to the higher income groups of profit earners, you surely will decrease domestic consumption. Now, this may sound theoretical to you, and I will show you the numbers Thomas, my co-author, and myself have been estimating for each country. That's a very robust finding. We can bet on it, so before you bet for the opposite, so please wait for our results. And as I said, we have looked at this for other countries. Ask me the difference between the marginal propensity to consume for between wages and profits for Mexico, Argentina, Korea, South Africa, China. I will tell you what it is. Now, okay, the last bit here. Let me move to the end of this. So far, I only have told you a national story. Now, I said there will be a negative effect of falling wage share on consumption. Believe me. Maybe there will be some positive effect on private investment. We will see if that holds, because private investment is not just about profitability, but also it's about what will happen to sales in the future. So it's a lot broader. So let's see what will happen to private investment. Net exports, yes, European Commission has gotten one thing right there. Net exports would go up if you decrease the wage share. But you don't have to be an economist, certainly not an econometrician, to guess what the sum of the three will be. Consumption effect negative, private investment demand, yes, might be positive, net export demand positive. Even if we take it that there will be two positive effects, one negative effect, the sum can be anything. It may be zero, it may be negative, it may be positive. That's what we call the general theory. We are not ideologues here. If you decrease the wage share under certain circumstances, under certain structural aspects of an economy, you may be able to grow, but maybe not. So let's look at the countries. That's what we say. Then we say one more thing. Look, European Union is one of the most integrated regions of the world. We are very open economies, but we trade a lot with each other. Ireland's most important trade partner is Britain. Britain's most important trade partner is the rest of Europe. We trade with the rest of the world as well, but extra-European trade is a lot smaller compared to the European total demand. So when we all dump our wage share in an effort to increase our competitiveness, to gain a competitive edge vis-à-vis each other, you can guess what happens. Our relative prices of export prices to import prices don't change a whole lot, isn't it? But what we are saying with Thomas here is, let's count that in. So let's look at all these 15 countries in interaction. When I change my wage share and all my trade partners in the other 14 countries do the same, what will happen to my import prices? Let me build that into my model. And also, their demand will change as well when they change their wage share. So some of the countries may be, like the European Commission assumes, may be able to grow when they dump wage share. These are countries that we call profit-led economies. That's the neoclassical idea. They assume all countries are profit-led. But maybe there is another group of countries in our general theory who would start stagnating or having a recession when they decrease their wage share. So these are the countries which we call wage-led countries. Mind you, these are not about the policies of the countries, they're about the structure of these countries. But wage-led and profit-led countries are trading with each other. So what happens when each other's GDP changes? Other countries' GDP is my export market. So let's see what happens. I know this is now the empirical results, the summary of the results. That's a lot of numbers here. Let me try to walk you through here. So we have the effect of a 1 percentage point decline in the wage share on each country's aggregate demand and its components. So all 15 countries of the Western European Union. Mind you, this is the simulation for 1 percentage point fall in the wage share, but I told you that wage share has fallen by 10 to 20 percentage points in different countries. So The first column is only private household consumption. I said Thomas and I could bet on that. So what is happening to consumption? All the numbers there are negative. How do you read it? Let's concentrate on Ireland for a moment. A 1 percentage fall in labour share national income in Ireland suppresses domestic household consumption in Ireland by about 0.2%. Multiply that with 20, you will get about 4% fall in household consumption as a ratio to GDP in the last 3 decades, accounted by the fall in labour share. In the UK, the effect is similar, about 0.25%. In some other countries, in Greece, the effect is dramatically negative. A 1 percentage fall in labour share in GDP leads to more than 0.5% fall in domestic consumption as a ratio to GDP. That's a fall in aggregate demand, of course. Now, what about the second column? That's the effect of the fall in labour share, hence the rise in profitability on private investment. You see there are some positive numbers and some zeros. Again, this wasn't something that surprised us. In Ireland, you see a positive effect of rising profitability on private investment. Yes, theoretically, I'm not surprised. In some other countries, in Austria, in Germany, in Greece again, in Britain, private investment doesn't even care about rising profitability. There are reasons for that I can't go into the details. It has something to do with financialization, but it also has something to do with the very fact that private investment is about the animal spirit, and animal spirit is suppressed if you dump household consumption. Who will buy the goods that they could potentially very profitably produce if household demand is being dampened by a stagnation of wages? Now, one thing, if you compare the first 2 columns for a second, if you could concentrate on that, is very clear. The negative effect of a fall in labour share on consumption is very strong. Its positive effect on private investment, however, is, even when it is positive and different from zero, it is not as strong. So if you were to look only at the domestic demand of all these European countries, that means they are wage-led, meaning they would stagnate if you decrease labour share. Now, this already brings me to an interesting point, because if we know that intra-European trade is what matters for Europe and extra-European trade is small, we could also think of Europe as a closed economy. Then what we would be left with would be actually only consumption and investment effects. So the dampening wage demand, wage share, and the demand that comes out of that is clearly signaling to be detrimental already by looking at the effects on consumption and investment. Of course, we do admit that there are export and import channels. So the next 2 columns are looking at that. Again, interesting point about Ireland. While your exports don't seem to be very responsive to relative prices, Irish exports are about the place of Ireland in the global value chains. So labor cost isn't what drives Irish exports. That's very interesting. Imports do get a little bit of a boost in the sense that imports would fall if labor costs here are decreasing. So there's something to gain on the import front, but not so much on the export front. So overall, if we add up net exports, that is the next column, with the effect of the falling labor share on consumption and investment, what we find is the final effect on private demand only. And mind you, these are only the effects in isolation. In the last column, if you have a negative number, all that means, say, for example, for a moment, look at Germany. If Germany decreases its labor share by 1 percentage point, private demand will decrease by more than 0.3 percentage point. Similarly, in the UK, private demand will decrease. These countries are wage-led countries, meaning in isolation, if they are the only countries in the world who would be doing wage moderation, they wouldn't be able to grow out of that. They are wage-led countries. Now, Ireland, next to that, you see a number that's very small, 0.006. It's positive. So what does that mean? When Ireland decreases its its wage share by 1 percentage point, growth in Ireland of private demand could potentially increase, but it's almost economically zero. But it's positive. For a moment, say that Ireland is a profit-led economy because it's a small open economy and international demand matters more. The effect of falling labor share on imports is giving a boost, and there's also a profitability effect on investment. But that's not the end of the story. Now, first of all, quite a few of these European countries are wage-led, even when they do the wage moderation policy in isolation. Finland, France, Germany, Greece, Italy, Luxembourg, Netherlands, Portugal, Spain, Sweden, the UK. They're all wage-led economies, meaning they could actually grow by increasing the wage share, even if they were the only country in the whole world doing it, provided others don't do further wage dumping. It seems like Austria, Belgium, Denmark, and Ireland are more in line with the European Commission expectations, but no, that's deceiving because as we have started this discussion, Europe is an integrated economy. Now, this table is trying to simulate what happens when all the European countries are implementing the same race to the bottom policies of wage moderation of the European Commission. The first column is already what you have seen in the last column of the previous table. The second one is just the standard Keynesian multiplier. To remind you, there is a debate about the size of the multipliers. I know my colleagues at the TUC are trying to tell to Osborne that actually multipliers are larger than 1, meaning if something happens to demand, the effect of that on national income will be multiplied. Our multipliers, luckily, are quite in line with what my colleagues elsewhere would be expecting, other than the neoclassical circles. So basically, multipliers are larger than 1 for Ireland, for the UK, for the majority of these 15 countries. But then comes the interesting part, the last column. When all the countries simultaneously decrease their wage share, what happens now? In the originally wage-led countries like Germany, France, or the UK, demand falls now even more because they are losing the little bit of export that they could gain by lower labor costs as well, because their trade partners are simply doing the same. Most of their trade partners, other European countries, are wage-led. Their economy is contracting when they do wage dumping. So German export-led model is also here getting, of course, a hit. But what I really like here in this table is the two countries, that's Austria and Ireland. And I feel quite lucky that we're able to present this in Ireland now. So Ireland, if you remember, if it were the only game in town doing wage dumping, could theoretically grow out of that. But the Irish capitalists aren't the only genius in Europe. We are all doing the same. They're all dumping labor costs. So when everyone does that, the Irish competitive edge is disappearing. So if you remember in the previous table, Ireland was having a little bit of a positive growth effect, although economically not very significant. In this case now, it's starting to contract. The number there is now negative. This means when every country in Europe decreases the wage share by 1% simultaneously, Irish growth would decrease by about 0.1%.
Özlem, I hate to tell you, but you're well past your time. So 5 more minutes.
Oh, that's brilliant. Okay. So here is now the positive note. Is there a way out of this race to the bottom? Yes, we have simulated a positive scenario where every European country coordinates to increase their labor share of orders of magnitudes of 1 to 5 percentage point in the next 5 years. Germany increases it by 1 percentage point every year. Ireland increases it in total about 3 percentage points in the next 5 years in cumulative terms. If we do that, what happens to growth in Ireland? Well, Ireland, out of this policy alone, will get some positive growth, 0.3%. Europe overall will get a big boost of 1.5%. The UK GDP will increase by 1% out of this coordinated upward race in labor share. The effects on investment is positive in some countries, but not in all. The bottom line of that is you need more than just in wage policies if you want to tackle issues of industrial policy, regional imbalances, and productivity differentials. You need investment policies, obviously. The other good news is the effect on your current account balance is almost negligible, but I'll skip over that. I'll end by discussing first what we learned from that. Well, what we learned, if we want to recover out of this crisis, Europe needs a pay rise. TUC had put that much better than me. Recovery needs a pay rise was last year's motto. We still need a pay rise, sadly. We are not there. Now, when I talk about that to trade unionists, they are usually worried about would that not lead to wage inflation, inflationary effects of higher wages. Roland had asked us this question, meaning he had prompted us to look into that such that we can give better advice and ammunition to the unions. We did diligently. So basically, if you increase wage share by 1 percentage point in Ireland, that means a nominal pay rise of 2.7% in 1 year. This will give you, yes, an inflation. How much? Of 0.6%. So my advice to the ECB, if you want to defeat inflation in Europe, you need a pay rise. You should actually target nominal wage increases, not wage moderation. How do we do that? We know how to do that. It's not novel here what I will say, but since it's so important, I will nevertheless repeat it. We need policies that will target not just the bottom, but also the top and the middle of the income distribution. We need both predistributive and redistributive policies. Predistribution is about labor's bargaining share, and this is so simple. It's about re-regulating the labor market, improving the union legislation, and increasing the coverage of collective bargaining. When I look at the British history of collective bargaining, it has been created by active state intervention out of nothing in the years after the First World War, all the way during the years of Great Depression. And come 1950s, Britain had a collective bargaining coverage of about 80%. Today, well, as it was generated by state intervention, it has been also dismantled by state intervention. The good news is we know how to reverse that. The bad news is we need the collective action of all of us. Predistribution is also about putting a floor. It's about having a decent minimum wage at the level of living wage. And since we are talking about coordination at the European level, it's about having minimum wages where minimum wages are linked to median income in each country such that we can achieve convergence. It's also about changing the social norms that set wages, and I'm going to refer to Diane's speech here. It's about closing gender wage gaps. Gender wage gaps is not a given. It's not about the marginal productivity of women versus men. It's about social norms. It's also about regulating at the top, putting a cap on executive pay, talking about pay ratios in the companies. Of course, it's about redistribution. I'm not going to talk about taxation policies because we have discussed that extensively. I will, however, add two more things we discussed, maybe less. It's about bringing back the social wage. Social wage is also a determinant of the bargaining power. So it's about bringing back the welfare state such that we have a decent, publicly supplied care, health, and education service and housing services. And last but not least, I think we haven't used the word today a whole lot. Francis has referred to that. It's about reversing the power of finance. It's about reversing financialization. And this relates to workplace relations as well. It's about regulating the finance. Now, what I haven't been able to say much is, most of all, this is all about avoiding beggar-thy-neighbor policies. It's about talking in Europe of a wage-led recovery scenario. And we have a basis for that. We have a material basis to avoid wage moderation. It's just a matter of political will. So what we need is a comprehensive policy mix of wage coordination, but complemented by industrial policy and investment policy. And of course, I said wage-led recovery is not the magic bullet to sort out all our ills. Here we are calling for a public investment policy in both social and physical infrastructure to deal with the multiple crises of care, ecological crisis, as well as inequality and jobs crisis. And we have an agenda of purple jobs and green jobs. So I will have to add that another hit I'm carrying is also to be a member of the Women's Budget Group. But I know the chair will not now give me the time to talk about what we mean by purple jobs. But you all know what we mean by green jobs. Purple is just the complementarity to that. Well-paid, decent jobs in care, education, and health for both men and women. Thank you very much.